Good morning, everyone. My name is Adam
No, that's
Myers,
fine.
and I lead the distribution team at Pengana. Thank you for joining us for our second webinar in this series, an update with Rhett Kessler, CIO and Portfolio Manager of the Pengana Australian Equities Fund. To give a quick introduction to those less familiar with our business, at Pengana, our key aim is to offer our clients differentiated strategies which will add value to their portfolios. We have no me-too funds in our business. Between Rhett and Anton, the Deputy CIO, they have over 55 years of investing experience, and this has certainly stood them in good stead as they remained calm and rational during this very challenging year. Today, Rhett will share the themes and trends that emerge from the reporting season and describe how the portfolio has been structured to navigate the continuing uncertainty. During the presentation, if you have any questions, please enter them in the question box, which is accessed from the icon on the bottom of your screen, and we'll get to as many as possible of them in Q&A at the end. Rhett, over to you.
Hi, good morning, everybody, and thank you very much for dialing in. It's certainly been an interesting period. I hope to cover three things today. First of all, I'm going to give you a quick recap of how we got to the current position. Secondly, we're going to talk a little bit about what we learned during reporting season. And then lastly, we're going to talk about how we've positioned the portfolio. So jumping right into it, if I could, Dean, could you go to slide 1? That's the team. Hasn't changed. As mentioned earlier, the one thing we certainly rich in is experience. And yes, it is in declining hair order, this group of people, but certainly many, many years of experience, and it certainly stood us in good stead over the last year. The next slide, please, Dean. So I guess we've done this for the first time in 13 years. We've added an addendum to the slide. It's always been about investors' needs have been capital preservation and then a reasonable real return and the definitions there. And the first conundrum that I'm going to deal with during this presentation is, as stewards of this money, how do we preserve the purchasing power of our clients' money and my own money in an environment of high prices in virtually every asset class? And we'll flesh that out, and of course we have a solution. Next slide, please, Dean. So just the recap. We entered in about February, where we had a period where, as you can see, we've assumed a trend line, the green line, where we thought fundamental value would accumulate at about 7 to 8% less dividends. In our view, equity markets had detached from fundamental value. And as a result of not being able to find things to buy, and a real concern that there was significant exuberance in the market, we not only ended up with a lot of cash in the portfolio, but also a significant put position. And the equities were very defensively exposed. Obviously, we had no idea that COVID was about to erupt on the global scene, but certainly equity markets, we felt, were overvalued. Next slide, please. And so what happened was we had this panic, this massive issue around liquidity events, and the world was about to end. And in my view, what this means is that you tend to do some of your hardest buying, and you tend to make sure, well, you need to make sure that you remain psychologically sound, because otherwise you end up just assuming the fetal position under your desk, because it's a very difficult period. Now, we absolutely didn't do that. Both our cash position, our puts, our experience, our level-headedness, etc., enabled us to apply over $110 million of our cash into shares at really attractive prices. Now, looking back, it's fantastic that we did this, but I can honestly say that it was probably one of the toughest periods in my 30 years of experience in this industry. And we call it reaching across the abyss. When we're being less kind, we talk about, and you've heard me talk about this before, We call it vomit buying, where you literally buy something, you stand up, you walk around the desk, trying your hardest to settle your stomach so that you don't throw up. And then you sit down, you buy some more at another 5% lower. And we did that consistently. It was exhausting. We were working from home. You know, the work from home arrangements have worked exceptionally well for us. But certainly when I emerged from my home office, my family said to me, you know, you've been in the office all day. Why do you look so exhausted? It's this environment that was exceptionally tough. And if I go to the next slide, please, Dean, I'll just give you a snapshot of what we did. And essentially, we added to existing holdings. We crystallized our insurance at extreme levels. Now, it cost about $1.25 to buy the puts. Our first tranche, we sold at about $4, another tranche at $9, another tranche at $15. A big chunk, I must say, very proudly, we sold at $20. And then we held on to a small piece that we sold just before the 6-month put expiry date at about $4.25. And so it was taking the cash and taking that put position, which we are very, very fortunate to have, and converting that into we think, fantastic equity positions that have set up the company or the fund for the next 10 years, went exceptionally well. We also took advantage of a whole range of new opportunities. We added Rio, the 2 gentailers, Meridian and Contact, which is not on the slide, is New Zealand gentailers. We added a big chunk of Ramsey and then got quite a bit of stock in the capital placement. We added James Hardie, Bapcor, Charter Hall. There's a range of companies, but really across the board. We also we participated in attractive capital raisings. We Cornerstone Credit Corp at $11. We participated in size at NAB and Ramsey at incredibly attractive prices. Likewise, Bapcor, Auckland Airport, which was subsequently sold. We were part of the cornerstone ring of the Flight Centre, raising at $7, etc., etc., etc. It was, you know, and I must make this point. For a long time, we've been saying, you know, we're conservative. We think pricing is overvalued. It's been difficult. And it's quite easy to do that and fall into that rut. And then you end up just always being too conservative. What we really find is that it's no good just saying you're conservative. You have to be able to act when opportunities present themselves. And certainly by deploying so much cash that we went from one of our highest levels of cash to our lowest level of cash in the fund, in the history of the fund, over a period of about a month during one of the most difficult periods I've ever been involved in, speaks to our discipline and our ability to act when needed. If we go to the next slide, bizarrely, things have turned almost 180 degrees in what seems to be a very short period. So not only did the market correct, and then you've had a big interruption in business momentum, but it bounced back enormously. And in our view, to some extent, we're now trading above fair value. And so we've done a 180-degree turn. So we've gone from our lowest level of cash to real net sellers at very attractive prices as a seller. So we've now, until recently, accumulated about 15% of the portfolio in cash. And we think there's a lot of exuberance around. And so that's a very quick catch-up as to, you know, how we got through this period. You know, my recent sayings have been, there's been years when nothing happens, and then there've been days or months when years happen. And certainly the latter has been what's been occurring over the recent period. Things have calmed down a little bit now, but you're still you're still seeing quite a bit of volatility as we backflip and forward flip from, you know, everything's going to be fine, the vaccine's going to be good, to, oh no, the world's ending, etc. And we're certainly navigating our way through that. So if we go to the next slide, please, Dean. So some observations during maybe the first 9 months is that there's a real tension we think, between share valuations and the underlying economic fundamentals. And what was exuberantly optimistic expectations were replaced first by fear and panic, and then certainly by this FOMO is well and truly back, this fear of missing out. Now, there have been the three horsemen which have galloped to the rescue. Government stimulus has been enormous. I can't remember another time in my career where we've seen this extent of government stimulus. I think they've done a really good job, particularly in Australia. There's no doubt that they've gone a long way towards building a bridge across the lockdown valleys and the COVID-19 valleys. And they've used virtually every tool in their toolbox, with today's budget being a good example. Certainly digitization, which we thought was an underlying structural theme, has been accelerated by anywhere between 5 and 10 years. And there've been a lot of companies that have benefited from this, and we think a lot more as well. And then, there's always the hope of the potential vaccine. Our working case is that the vaccine, a working prototype, will be ready within the next few months, and maybe by December, January, but certainly putting it into production, scaled production and distribution could take substantially longer. So, markets always try to anticipate what's going to happen. Certainly, we don't think that the vaccine will be widespread this side of the middle of next year. It'll certainly be in the latter part of next year. We hope for sooner, but we're planning for the worst. There's no doubt that earnings forecast risk is high, in fact, off the charts, and we'll come to that in a bit more detail. And also, we're getting increasingly concerned about geopolitical risk escalating. And I'm not just talking about the China, US, or issue, or India, China, etc. I'm talking a lot more about the impact of COVID in certain societies, where the already stark difference between the haves and the have-nots has been even exaggerated. And obviously the US is one of those areas, but we were concerned about places like South Africa, India, Indonesia, Brazil. Next slide, please, Dean. So I've often asked at this point, having just come out of reporting season, what observations we have. And certainly those first three words of noise has never been more appropriate. And some of the reasons for that is, you had first three quarters were starkly different to the last quarter in terms of the business momentum. And you also had, like you do with different demographics, you had the haves and the have-nots within companies. And so you had companies whose digital value proposition was accelerated, and so actually did remarkably well in the last quarter. And then you had a whole host of companies who collapsed in terms of the lockdown and the impact it had on their businesses, like travel, hospitality, events, certain retailers, etc. And so the whole reason we look at earnings releases or earnings results is to see if we can use them as a base for predicting the future. And certainly this period, I don't think, was that useful. Most company management teams withdrew their guidance. I always think it's a luxury having a company telling you what they think they're going to do, because it's really our job as predictors and investors to try and work it out ourselves. But it certainly helps having company management do it. And if they're uncertain, it certainly means that we're likely to be uncertain as well. There's no doubt there was enormous stimulus with JobKeeper and JobSeeker, and then enormous cash flow benefits where governments provided a lot of liquidity by allowing companies to pay their tax later, and also accelerating their own payments into the system. and we think those cash flow benefits are certainly unsustainable. Also, the impact of lockdowns on consumer and business behavior was enormous. Some of it will stick, obviously. We're already seeing some reversion of some of the things like online shopping in Western Australia and South Australia, where life has pretty much returned to normal. Bizarrely, not as much of the online sales has stuck, so it's dropped back down to historic levels. I think that's probably not true. I think it'll be broader. I think online commerce has gained significantly, but where it settles is still unclear. So reporting season for us was filled with noise. What we decided to do instead was not to waste a crisis, but really see what we could learn about really who has the power in every stakeholder relationship. And I've got some examples there. So the first one is, if you're an omni-channel retailer, so what that means is that you can sell stuff online as well as using bricks and mortar. Certainly your power against the landlords was much more powerful than a pure brick and mortar player. And so we've seen the Accent ones, the JB Hi-Fis, people who operate within the retail environment as both landlords, through their landlords as well as online, were able to negotiate incredible outcomes with the landlords. The other stark change that we've just seen in the recent update is the banks were absolutely the pariahs of society, and after enduring 18 months of Royal Commission inquiries and front-page newspapers articles about how bad the banks are, we've now seen acts being changed, particularly around responsible lending, and the banks have certainly come to the party to repair their social standing and their social operating license. And for several quarters, probably as long as I can remember, 2 to 3 years, we have seen good experience from the banks in general cost cutting, offset significantly by compliance costs. And we're talking hundreds of millions of dollars per bank in these areas. So that's been a big change in terms of the way the banks are viewed. And another example would be something like the private hospitals being seen as a scarce resource. So even though surgery was put on hold for a while, the government sought to underwrite the capacity in those areas by keeping them at break even, making enormous payments to the private hospitals to make sure those resources were retained. So Dean, if I could move on to the next slide. And please guys, if anyone's got any questions, just jot them down or start sending them in and we'll deal with them. I'm not going to be going for that much longer, but happy to take as many questions as you wish. And so I'm going to raise a whole lot of really big questions now that are exercising our mind. We do have answers for them and happy to explore any of these on the call, on the webcast. And so the important questions for us at the moment is, with regards to companies that we invest in or seeking to invest in, is, first of all, can the company survive? Sorry, that's not great English, but can it survive through its balance sheet or its business model? And not only that, can it emerge stronger and actually thrive? And does it have the leadership to adapt to new paradigms? And we've been very, very happy when we looked at companies during this tough period that by and large, most of the companies we're invested in have got these specifics. But now the much bigger conundrums that we're facing just generally as investors, and when I think about as an investor, I'm thinking about essentially my job as a steward of my clients and my own money my job is to ensure that I can both preserve and grow the purchasing power of that money. And that's really important. So we're talking about real purchasing power, as in real after adjusting for inflation. And so the bigger conundrums we're facing is, first of all, can government stimulus do the heavy lifting? You've had a real interruption to GDP. So GDP, remember, is the combination of a number of productive people times their productive capacity. And if you're in lockdown, you have a dent to GDP. And so within Australia, we think that we should recover pretty quickly. Bizarrely, the lucky country continues to be lucky. So the fact that China is reliant on our iron ore, plus the fact that we think there's a massive boost to come agriculturally from what is going to be a very good agricultural season. And also, we're a net exporter of tourism dollars. And so the domestic spending could more than make up for the lack of inbound tourists. So the government's gone a long way to building this bridge across the lockdown valley. It's using the big four banks as important pillars in this. It's using its stimulus programs, its infrastructure programs, and as you've seen from the budget, the ability to print enormous amounts of money and inject them into the system. And that's a really interesting segue into the next, and probably one of the hardest conundrums we have is what is a dollar worth in any currency? And I don't mean, what's an Aussie dollar worth versus a US dollar or relative to other currencies. I just mean is that if the printing presses are turned on in every single jurisdiction, what is a dollar worth? And this obviously begs the question about inflation. Now, I've been concerned about inflation for some time, and I've obviously been wrong. But for me, inflation very simply is more money chasing the same amount of goods. And so you're starting to see signs of massive price inflation. If anyone's tried to book a holiday for these current school holidays, you'll have noticed that the cost of domestic accommodation has gone through the roof. If anyone's tried to buy a used car in this environment, used car prices have really spiked up. You may have noticed that the amount of promotions at the big supermarkets have dwindled to almost nothing. You may have noticed that buying electronics and from JB Hi-Fi, Harvey Norman, or the promotional sales disappeared. And that's really because the demand is there. I always use the coffee factor. If you go to a suburban cafe and buy a cup of coffee, it's certainly price, is going up. So we're starting to see pockets of inflation, but certainly the cost of money keeps getting lowered, and so your cost of your home loans certainly haven't gone up. But bear in mind that if you're a steward and you're worried, if you're a steward of someone else's money and you're worried about asset prices being too high, the luxury of being able to rest in cash until you find something to buy is not as attractive as it used to be. And what I mean by that is you're not getting paid to be in cash. And so we're getting increasing requests for advice on what to do with your money, because 0.75% in term deposit just doesn't really cut it anymore. And I would put to you that with all this money surging around the system because of liquidity and cheap money, is that's having an impact on asset prices. And so you're seeing deflation in the value of your actual cash. The third conundrum that we have is, what is the actual cost of money? Now, what I mean by this is that for many years, we only had to work out three things. We had to work out the cost of money, we had to work out the quantum and certainty of future cash flows, and then we could price our risk and return for investing in an asset. And I used to spend 98% of my time, or 99.9% of my time, on the quantum and certainty of future cash flows, because to find out the cost of money, all I had to do was look at the 10-year treasury bond or government bond yield, and that would tell me the cost of money. So what we think has happened is that governments or central banks around the world have crushed the cost of money, so that there's no price discovery on the cost of money. So we can't use the 10-year bond as a proxy for the cost of money. And to some extent, I think in 20 years' time, when we look back at this period, we are going to say that central banks around the world exhibited or executed one of the greatest heists of all time on the general investor or saver, because by crushing the yield curve around the world, they have forced investors and their advisors up the risk curve. So you have to take on more and more risk. So you can't be in cash anymore. You can't be in fixed interest anymore. You can't be in property anymore. And so, all roads point to equities. And we're really seeing that more and more money has squeezed into equities, because that's the only place you get us in hope of a return. And this is a real concern, because particularly as uncertainty builds, moving to equities becomes fraught with more and more risk, particularly if you're worried about capital preservation. And so when you put all these factors together, you really get kind of snookered or cornered. And you're stuck between FOMO and TINA, FOMO being fear of missing out, and TINA being there's no alternative to equities. And so our gig is to try and find assets that can preserve and grow the purchasing power of our clients' money. And what we've arrived at in terms of this solution is if we can find what we call hard assets. And those are assets that, due to their pricing power, can monetize the scarceness of those assets in a way that gives us a decent return. That is our solution. And we're calling them hard assets, although some of them would be around intellectual property or networks or scale. But we're calling them hard assets. And so let me give you an example of some of them that we've found. And the portfolio has taken on a shape that has changed quite a bit over the past few months. Now, let me be clear. We have absolutely not changed our spots. We have not started chasing, very, very high growth, loss-making tech companies. We have not done that. We're still doing exactly what we've always done, but we've found that some of the value is starting to materialize in some places that we haven't been before. And so, Dean, if I can ask you to go to the next slide. Thank you. And so I'm going to pick number 3 on the list of the top 10 holdings, Waypoint REIT. And just while we're doing that, I'm going to point you across to the right, where we've provided a bit more color as to the sector exposure. And so, as you know, all our yellow or beige, or whatever that color is, companies, sorry, I am a bit colorblind, but all those things fall into our defensive bucket. And more than 50% of the portfolio is in our defensive bucket. And remember that 14% of the money is still in cash. And so for the first time ever, not only do we have REITs, but 10% of the portfolio is in REITs. And so if I just go to what Waypoint REIT is, and that's about half of that 10%, we've managed to find a company that we were able to buy at a very, very attractive yield. And we're talking about very high single-digit yields. And this company essentially has an 11-year WALE, which means its lease expiry dates on average 11 years or longer. So it is 11 years of certainty. Its 95% tenant is Coles through the Shell petrol stations. So essentially it's the landlord for the Shell forecourts, those pieces of land that the petrol stations are built on. And it has a 3% inflator. So every year, the amount of rent they charge goes up by 3%. And my favorite part about Waypoint REIT is that all its leases are what we call triple net, which means essentially the management team turns up every month, puts out its hand, and Coles or Shell pays them their rent. And Coles or Shell takes care of rates, taxes, maintenance, capex, everything else. So that's what triple net means, is you just pick up your rent check. And we often tease management about why they need a CEO, CFO, and IR person to act as the go-between Coles and ourselves in terms of delivering our rent checks. So we think that we were able to accumulate this above an 8% yield during COVID. We think essentially lending money to Coles for 11 years was an 8-9%. It's now down to about 5.5-6% because the share price has gone up. So lending Coles the money for 11 years at a 3% inflator every year is a good deal, and that for us is a hard asset. We've also introduced Mirvac and Charter Hall into that area. On the opposite extreme, our view some time ago was that with all the printing presses being turned on, we felt that given the cost, gold price to some extent is determined by the cost of getting the gold out of the ground, and that it's an alternative currency, we felt that holding gold would be providing us some protection against all the printing presses being turned on. This was at a substantially lower gold price and substantially lower gold share prices. We don't like holding physical gold because it doesn't generate an income, but instead, if we could find a company that was the lowest cost gold producer, had a well-diversified set of gold mines, and was run by a competent and honest management team with a balance sheet that had no debt in it, and we could buy it at a nice after-tax cash earnings yield in the double digits, that would certainly be our first prize. And we managed to find Evolution Mining. It's done exceptionally well for us. We've trimmed it quite substantially, but certainly we've never owned a gold company before, and it's done really well for us. And also we've got Rio, which for us is all those things we said about the gold mining company. It is the lowest cost producer of iron ore. Its balance sheet is squeaky clean. Even at substantially lower iron ore prices, we think we can get a double-digit after-tax cash earnings yield out of this business. So very, very comfortable with that business. And then, there's lots of other hard assets, like we have healthcare, where, owning the hospitals or owning the IP that's associated with sleep apnea, or, in the case of ResMed, or being the lowest cost global blood fractionator for product that saves lives, we think are good hard assets. So our position in healthcare is quite big as well. And then you've got waste management, where you've got scarce assets that are dealing with a growing problem domestically, and we think it's quite similar to an oligopoly. So that's the shape of the portfolio. There has been a difference, but we think that they're well thought through and consistent with our underlying investment philosophy that has not changed for the 13 years that the fund has been in existence. So what I might do is just go to the next page, please, Dean. I always put this one up because it's fascinating. Essentially, this is the cost of money. And why we're unsure about the cost of money is we don't think it's 0.5%, or closer to between 0.5% and 1%. And this is one of the longest time horizons we've got looking backwards in terms of the cost of the money. And it's just bizarre that it's never ever been lower. And so bear in mind that long duration assets, the value of them go up when the cost of money comes down. But unfortunately, the reverse happens when the cost of money goes up. And so we're very cognizant of where we are on this scale. And this creates a lot of things to worry about if you're worried about the preservation of money and getting a decent return. And we are absolutely laser-like focused on this. Next slide, please. So there's a short synopsis of what's happened over the period. We've had a very positive start to the financial year in 21. We're up 1.5%. As I pointed out, our cash levels have built up again, and they do move around quite a bit. And there's absolutely almost nothing to be gained from being in cash. But for us, cash is a risk-free, interest-earning option to buy value if and when it emerges. If we go to the next slide, so for the quarter, our main contributors have been Super Retail Group. That stock was priced as though no one would ever buy another pair of soccer boots from Rebel, which is one of their divisions, and no one would ever buy another pair of windscreen wipers from Super Cheap Auto. Aristocrat, we were able to buy on a low double-digit multiple, even though it operates in an oligopoly that offers incredible value to shareholders. Credit Corp, you guys have heard me talk about this many times, but we still think it's standing business. And Accent Group, we've been very, very active there, and that's one of the best retailers, we think, in the country. Detractors, I must say, Telstra has been very disappointing. We still think the investment thesis holds up particularly well, and confident that we'll make a lot of money on that. It's offering a 5% yield, fully franked, and we think that yield is sustainable. So what have we added? Mirvac, as discussed. EBOS, which is a healthcare distributor of products to companies like Chemist Warehouse and their own pharmacies. It also has a big animal supplies business. And then we've bought quite a bit of Cleanaway recently due to its management issues. What have we sold? Can I just say that over the last 2 to 3 months, we've sold virtually something of everything. It's a long list, but we've sold out completely of JB Hi-Fi and James Hardie, and we've reduced our exposure to Credit Corp, and we've significantly reduced our exposure to Westpac. Maybe last slide, Dean, and then I might throw it open for questions. So just to remind you about this slide, it's a tough gig, what we've set ourselves. So our job is to take whatever that I think it's blue line, that flat blue line near the bottom, and we add 6% to that. And our job is to stay above that. And that's our job to do. The grey line is what the market's done. And yes, it has been a tough period for both the market and ourselves over the last 12 months. We fully understand that, but we think the portfolio now is exceptionally well set up, and we look forward to demonstrating that. So I understand that there are approximately 4 questions at the moment in the pipeline, or 5, and I might throw it back to Adam to manage that.
Thank you, Rhett. I think the first question, actually, I'm not even sure if it is a question or just a statement, is referencing the points that were made at the outset about the value of your experience, and the counter that was made is that no 2 crises are the same. Can you give us a sense of how your previous experiences through the numerous disruptions that have come before have helped or hindered you this year?
Yeah. So, I mean, I think it's a really interesting perspective. No 2 crises are ever the same. This job is tough in that you're always learning. The market's always teaching you. And we don't believe it's so much as what happens to you in terms of the crisis, but how you react. And so a couple of things. First of all, we believe that, and I certainly have spent my whole time running the fund with this as my major job, is to make sure that not only do we stay financially sound, but that we stay psychologically sound. My father always taught me that, you make good decisions from a position of strength, and you make really terrible positions from a position of weakness. And so one of the things we have consistently, and I can think of one instance where we didn't, but other than that, we have consistently been well prepared for periods where markets become vulnerable to big setbacks. And the way we do that, the way we prepare ourselves, is by having A, cash on hand so we can act. B, the last three big crises we had puts, which stood us in good stead. The amount of work we do per company so that we understand what it is we're buying and why we're there always stands you in good stead. So, if you're only in a stock because you think it's going to go up and it doesn't go up, then what do? Whereas we have an investment thesis, we have milestones against which we test the investment thesis. And it's having confidence in that process, in that it's worked consistently for long periods of time, is what helps you get through each crisis. And so I'll give you some flavor of what we go through when we hit these kind of times. So at the moment, it's probably the most relevant, is we've got situations where, take a Mirvac, for instance. Mirvac, 45 cents in the dollar, is office property. And the consensus view out there that office is dead. And everyone's been selling their office investments. Now, we sit down and we understand the business pretty well. We think that the management team of Mirvac is an exceptional management team. We think they're one of the best, maybe themselves and Charter Hall rank simultaneously. Secondly, we say, well, it's 45 cents in the dollar. What about their logistics business? What about their residential business? So the whole discount being ascribed to the business is magnified if the other parts of the business are okay. That means there must be about a 40% discount on the office property. Thirdly, we say, well, what is the problem in the office property? The problem could be that their tenants are going to stop paying rent, or when they relet that space, the new tenants or the existing tenants will pay much less for their rent. Well, there's an average of 8-year contracts around that space. So we think that Mirvac could probably hold up its earnings for the next 4 to 5 years as we get through this period. And so when we put that all together, we realize that just because everybody else is leaving, in other words, going out the room, doesn't mean that that's truth. It could just be sentiment. And so we do all the work, we have milestones, we have access to management, we speak to all the people. And I guess that's another one, having the experience in this market and having the gravitas so that I can pick up the phone to a Susan Hurwitz or a Campbell Hannon who run those businesses and actually ask them what they think. And then I can speak to a Darren Steinberg who runs Dexus, and we can access, through our contacts overseas, what's happening in office around the world. And we can speak to the big companies that are actually the tenants. We can put that all together and actually come to a conclusion that as we buy Mirvac and it continues to fall, feels really terrible. But because we've got an investment thesis that we believe in, and we sort of checked, we have the courage to be able to follow through on that. And so having spent about $10 to $20 million on buying Mirvac at 208, 205 dollars, it's very comforting to see rationality start to reassert itself and prices move upwards. So yes, every crisis is different. I know this is a long answer. The job never gets easier. If it was easy, everybody would do it. I would caution you on one thing that does seem to be occurring. And in the good old days, you used to get in a taxi and get your tips from the taxi driver and you knew it was the top of the market. Currently, all you need is a kid who's a millennial and all his mates know that you're the share guy and you're getting tips from virtually everybody. There's a lot of froth around. And so we're steering clear of those and playing where we think there is value.
Thanks, Red. Next question, can you please tell us more about your decision to buy Vivo REIT?
Sorry, I didn't hear the last bit of that question.
Your decision to buy Vivo REIT.
Sorry, Adam, you said our decision to buy what?
Vivo REIT.
Right. Yeah, so it was one of those things where you get a little bit lucky as well. So just before COVID hit, Viva Energy sold down its 40% stake in Viva REIT at approximately $2, I think it was 66. We already had a holding and we didn't participate. That stock went predominantly to quite weak hands. It was fascinating because as COVID wrapped its tentacles around sentiment and fear, a hedge fund literally blew up and was partially liquidated, and a couple of big industry super funds had to reallocate or rejig their portfolios. And so there wasn't a day that didn't go past that I didn't get a call from a particular stockbroker who was trying to help place all the stock, trying to give me sell me shares. So every day after market, I'd get the call, Rep, would you like some of the stock? It's not as bad. Look at the yield, etc. And we kept saying no until below $2, we quite a nice yield. We reached across the abyss and doubled our holding in that stock. And that's how we essentially built it up to one of our largest positions. So sometimes no matter what your investment thesis, you need a bit of timing, a bit of luck, and the ability to act.
And related to that, can you give your view on the threat of electric vehicles, Waypoint, REIT, Vivo, etc.? The person who asked this question apparently owns 2 diesels, so he's not concerned, but wondering if you are.
There is no doubt in my mind that internal combustion engines, if that's the question, are a sunset industry. The real question revolves around, how long is the tail? Now, if I have an 11-year whale with Coles, so that I'm contractually bound to pay us for 11 years, I have quite a bit of mitigation around the next 11 years worth of earnings. But being the long-term investors we are, we then need to think about, post that, and given the locations, inner city, urban locations, alternative use for those assets, we think are quite positive. We're a little bit concerned about the regional bits, but we're doing more work on that, but we have some time to work that out. Generally, though, I certainly believe that the electrification of vehicles has accelerated and will continue to accelerate. And so we're constantly reevaluating our tail for the sunset industry of internal combustion engines and I guess the energy sector. Yeah, I mean, that's as clearly as I could put it. So, it's a work in progress. We currently have about 3% exposed to Caltex, or the old Caltex, now called Ampol. But it's largely around the infrastructure they have in servicing Australia's energy needs rather than the actual sale of petrol.
Great. Next question, Rio, reputational damage from the wrecking of the Aboriginal heritage sites?
Yeah, so this is a really interesting question, I guess. And I mean, while there absolutely was mismanagement of what they did, we should always be aware that the press doesn't always allow the facts to get in the way of a good story, right? So a couple of things. First of all, we've had a lot of people say to us, gee, how dare you own Rio? Look at what they did, et cetera, et cetera. And even if that was correct, the assumption of what they did was correct, which, I'll just put out there for a sec. We have a very firm belief in ESG. And I know this may be controversial, but it really is a very firm belief in that corporate responsibility as an investor is absolutely not being invested in a company and then when they do something wrong, dumping and running. Right? It is absolutely staying on board because it happened while it was on your watch as a shareholder and using whatever rights you have as a shareholder to vote or act against it and put pressure. It is not dump and run. And I'm always amazed by people who are so outspoken about ESG, calling upon you to dump and run. And it's something that we won't do. Right? Now, if we've had a huge effort and we find that management and the board are intractable, well, then we have the option to leave, right, and vote with our feet. But certainly while we're there, we have a strong responsibility to stay and do something. And so we have been active in that. And our view on a very good business is that you can always change management, you can't change the business. So we think that the business will win in this case. Secondly, there's a lot of stuff. I mean, legally, it doesn't appear that we have actually done anything legally wrong. It looks like they got the approval, and they acted on it. And if they had done something illegal, they would be, the courts would be active. And they may still be, maybe they have done something, but so far, they've done anything wrong. Now the flip side of this is that we don't like the way it's been managed, and we think they should have, erred on the side of caution, and some things have been mismanaged, and management had paid the price. Doesn't bring back the assets that were destroyed, absolutely, but management have been changed and are still being changed, and we think the board is being changed, and so we think that's a good outcome. That there's got to be accountability, and there's got to be consequences. And we think the new team and the new board will be even more cognizant of the issues around there. And so we think we're on the right track now. So sorry, I may have got a bit passionate about how that all plays out, but certainly strong belief on our part.
Thank you. A couple of questions now about JB Hi-Fi and your decision to sell it.
Okay. So let me just say that we've been a big shareholder in this company for a long time. Our view has and remains that this is one of the best retailers in Australia, and that the management team is superb and the business model is superb. The purchasing power they have been able to exhibit, particularly during COVID, in getting stock on board, particularly as customers or suppliers around the world were pushed for stock by every retailer in the space. JB Hi-Fi's ability to grab that stock and then execute on enormous volumes has been fantastic. So why did we sell our holding? Well, at some stage, no matter what you build into the stock's future, it just gets too expensive. And so, when we were buying it at sub $20, and everybody was telling us that Amazon was going to destroy the business, and no one was ever going to buy another iPad or pair of speakers from JB Hi-Fi, or TV set or whatever it is people buy from there, that's a big issue. We felt that the business would not only survive, but would thrive. Now, turn it on its head, virtually everything for the company's gone right. We feel it's over-earned over this period, and this is certainly not a sustainable level of earnings. We think there's some tail to it, but certainly not sustainable. More importantly, the cash flows, due to timing differences that I mentioned early on, where the government allowed them to pay their tax later, made all the payments early to companies. They benefited enormously from supplier payments being delayed, etc., etc. They actually got 2.5 years worth of cash flow during the past year. And, a 25 PE for a business that's on peak earnings and cash flows will be negative for the next year as the timing differences revert, we just felt was too rich. We would love to own it, and we've got a watching brief on it as soon as it comes back into with Kui of being at the right level, but we have to exhibit our discipline, and we've moved on.
Rick, we've got a couple of questions left, and in the interest of time, I'm going to ask you to be quite succinct in your answers.
Okay. Thanks.
Please can you remind us when you had 20% in cash?
It would have been either intra-month January or intra-month February.
Thank you. And next, you mentioned that you increased your exposure to banks. What banks were they, and your thoughts on banks going forward?
Well, the reason we increased our exposure to banks was because we put our hand up for an enormous amount of NAB shares in the capital raising, and we were exceptionally fortunate in that we got more than our fair share. So we got over allocated shares. We worked pretty hard to get that outcome, but I'm very happy to say that we got it. So, and the reason our thinking around that was there are two great banking franchises in Australia, CBA's retail and NAB's business banking. And anytime you can get one of those franchises at a 25% discount to book value, we'd like to take it. We have reduced our exposure to Westpac significantly. And so our bank exposure is just under 10%, which is a big bet for us.
Great. That is all the questions. So thank you for joining us for this update today. Listening to Rhett speaking, what really resonated with me is that although the market environment has been anything but usual, nothing has changed about his approach. His focus is still on preserving capital and generating the reasonable return that he's always spoken about. And at the moment, hard assets are playing a significant part in engineering these outcomes. But if you think about it, in the current uncertainty, what could be more important than those two objectives? Our next webinar in the series is on Wednesday the 14th with Jordan Svetnovsky, who manages our international equities funds. For those of you who haven't registered, I urge you to do so at pengana.com/webinar. If you have any other questions, please get in touch. We'd love to hear from you. Thank you very much and enjoy the rest of your day.